I appreciate it. Thank you, everyone, for joining us today. When we first talked to Carl and the team, they gave us the headline of what's the return on the news. We specialize in applying behavioral finance. And today we have Professor Tom Howard, who taught at Denver University for about 35 years. He's a pioneer in the area of behavioral finance and particularly the application of behavioral finance. Today's presentation is the idea of investor emotional intelligence. What's the return on the news? Today's discussion will give a little background, sort of landing on planet behavior and kind of the research behind behavioral finance. We'll dig in a little bit to how our brain works and how it drives our behavior. And then we'll talk about investor emotional intelligence and the things that we're sort of hardwired to do the wrong things and how we can strengthen our investor emotional intelligence and try to avoid those mistakes. And then we'll finish up with questions and answers. So now I'd like to turn it over to Professor Howard.
Thank you, Lambert, and thank you for joining us.
Hey, Lambert, can you turn on your camera?
We can. We thought you might want to watch the presentation instead of our mugs.
We love you guys.
Happy to do that. Can you see us now?
You look great.
Okay, great.
Thank you, girl. So welcome to Planet Behavior. This is a planet that I joined about 15 or 20 years ago. And it's really a different way of looking at things from investing, planning, and advising. And it really does open up some tremendous opportunities. My background was very much in the idea of informationally efficient markets, competitive pricing, and the whole idea of modern portfolio theory. My background is very quantitative. I've got an undergraduate degree in engineering, master's in management science. I got a PhD in finance, statistics, and economics. So to make that transition 20 years ago was really quite a sea change for me. And so I can appreciate the kind of things that you might be thinking about and thinking about markets and planning and advising in terms of behavior. Let's talk a little bit about the research that underlies this. This really started 50 years ago, looking at the idea of behavioral finance and behavioral economics, and has been recognized by the Nobel Committee now. There's some key conclusions that are coming out of this particular research. It really started with Daniel Kahneman and Amos Tversky back in 1970. And they asked a really pretty simple question. It says, how do people actually make decisions? That in those days, and still to a large extent today, the idea is that people are rational. They make rational decisions. They maximize something called expected utility, whatever that is. And that was the prevailing notion and had been for several centuries prior to 1970. But they asked the question, how do people actually make decisions? And they were kind of hoping to find rationality. They were psychologists, both in universities in Israel. And at that point in the social sciences, which psychology is part of, the top of the pyramid was economics and their rationality model. And that really had spread through all of social sciences. And so they were kind of hoping to raise the reputation of psychology and really identify that people do make rational decisions and how they do that. So they began to run a bunch of tests, and it turned out that they couldn't find much rationality. And they kept digging and looking at it in different ways, and it just kept getting worse and worse. In fact, it's even worse than they initially thought, because not only are people irrational in making many decisions, but you can actually fool them fairly easily with irrelevant information and have them make poor decisions based on irrelevant information. And so Daniel Kahneman received the Nobel Prize in 2002. His compatriot Amos Tversky would have joined him, except he passed away in the mid-90s from cancer. And the basic conclusion they reached is people are not rational. There's just lots of emotional, irrational decisions being made by individuals. The next level that was launched was in the early 80s with Bob Shiller. And just prior to that, Gene Fama had posited that markets were informationally efficient. That meant that prices reflected all relevant information. And that was the prevailing theory at the time in the early 80s. And so Bob Shiller said, well, how about we test that? Let's look at fundamental information. Can I explain changes in stock market prices based on changes in fundamental information? And he did a study in the early 80s and said, well, no, you can't. It's really bad daily and monthly and even annually. We can't explain volatility in markets based on changes in fundamental. And so he posited that markets are not informationally efficient. Well, that created a firestorm in the academic community because the idea, again, the prevailing theory was that markets were informationally efficient. And so that particular idea has been challenged numerous times over the years, but it has stood up. And so in 2013, Bob Shiller was given the Nobel Prize in economics for that particular line of research. Interesting enough, that same year, Gene Fama also received the Nobel Prize. He's the one that posited that markets were informationally efficient. And so it was kind of wonder, were they going to get along when they received the prize? And in fact, they did. So the bottom line is markets are not informationally efficient. Prices are not driven by fundamentals to a large extent. And so that's the second pillar that of behavioral finance. And then Dick Thaler, whose academic career paralleled mine, starting in the mid to late 70s, he started into behavioral finance way before I did. He joined Planet Behavior at the very beginning of his academic career. And he began to record all these kind of strange decisions that people make, kind of confirming what Kahneman and Tversky and many others had come up with. But he went a step further. He says, so is there some way that we can help people make better decisions? Let's see if we can have them avoid these emotional decisions, these cognitive errors as they're described. And he came up with the notion of behavioral nudging. And he received the Nobel Prize for that in 2017. Behavioral nudging is really the basis for investor emotional intelligence. How do I make better decisions and somehow control and manage my emotions and my behavior? It is also the basis of how we manage money at Athena using behavioral investment management. So the foundation for Athena and the work we do, again, I was a faculty member for 30 plus years at the University of Denver. And I founded Athena in 2005, and I began to do research in various areas of behavior. One of them was strategy identifying active equity managers. Another one was based on that research, can I identify going forward the best funds and the best stocks? And then the one that really surprised us as we went through this is, can we identify the best markets going forward? And we developed something called market barometers. And we applied for patents, both U.S. and international, received 6 of them. And so that's our patented behavioral research. I continued my research from my academic days and continued to write lots of articles. These are 3 of the books that I've written. The most recent one, The Return of the Active Manager, which is a 2019 book. So this is the foundation upon which Athena is built. It also is the idea that you look at the markets through the lens of behavior, some really interesting things start showing up. So what are foundational concepts of behavioral finance? One that I've obviously alluded to earlier was that market prices are dominated by emotional crowds. So we used to, when I was in academics teaching, something would happen and you try to think, well, now, why did that happen? And what was driving it? And is there some kind of fundamental reason for it? And the more you look at it, and anybody who's active in markets and investing finally concludes, well, there's really not much rhyme or reason to this. Emotional crowds drive prices, particularly individual stock prices, even broad indexes like the S&P 500 over short and longer periods of time. So again, viewing the markets through the lens of behavior, it really are emotional crowds that are driving prices, and we need to think of it that way in making our investment decisions. Once you think of it that way, then unique investment opportunities arise, and that was one of the great surprises for me personally, because I was a strong believer in efficient markets, and I wasn't sure that active management really worked. And when I started looking at it through the lens of behavior, then all of these unique and really very profitable investment opportunities began to show up. So for long-term portfolios, short-term volatility represents emotions, not risk. This is a really important step in becoming a better investor emotional intelligence to improve that. Short-term volatility is very emotional, as we've seen over the last couple of years and really as far back as you can look. But for building long horizon portfolios, it is not risk. It's highly emotional, but it's not risk. And so making that transition is really important. Now, that doesn't mean we're talking about the short-term needs, your emergency funds and so forth. But we're talking about when you're building long horizon portfolios, so you need to make that switch away from volatility as risk. And then a really important result of this is behavioral management can dramatically improve success. This starts in the planning process to the advising process to investment management at every stage. And again, this is some of the really important aspects of improving your investor emotional intelligence, is being able to consider both emotions and behavior at every stage along this particular process, and leads to improved success for clients. Our brains drive behavior, and mostly without us noticing. So much happens subconsciously, as we know. And so that's important to understand what is driving us in making decisions. The human brain is old. We believe it hasn't evolved about 150,000 years ago. So imagine the world 150,000 years ago. Your brain is optimized for that period of time. And of course, we were surrounded by lots of threats, saber-toothed tigers, so forth. And it really was so our brain at its core is optimized for what the environment we faced 150,000 years ago. It is hungry. It consumes 20% of our daily energy, but is only 3% of our body weight. So it's an energy hog. And so one of the things the brain has to do is continually economize on energy. So it develops all kinds of shortcuts for making decisions. And this is important because, again, thinking, it consumes a lot of energy. And so anytime we can make a shortcut, that saves that energy for some other purpose. And then finally, it's impatient. Again, it's optimized to survive the threats faced 150,000 years ago. And those threats were significant. So if I'm standing there and all of a sudden the saber-toothed tiger shows up and maybe he's 100 yards away, I'm not thinking, well, let's see, I think I can outrun him and I don't think he's going to come after me. What of course you do is you immediately begin to run and get away from that. And so that's impatient. Our brains are optimized to make very quick decisions because that really allowed us to survive and be here today talking with one another. If we didn't have that particular feature, we would not have survived as a species. So what does this 150,000-year-old brain look like? So here's the various components of the brain. And this brain, we think, got built up from the brainstem all the way up to the frontal lobe. So the different functions of the brain, the kind of the automatic part of running your body to more conscious thinking, is these different layers that have developed over time. Very important is the amygdala. The amygdala is the clearing center for threats, for all kinds of emotions, all kinds of stimuli and emotional memories. So it is a clearinghouse for all of those activities. And so it plays a central role in the way our brains respond to different situations. Of most importance is the threat response. And this is immediate. Once a threat is detected, our higher level thinking gets reduced. And then we have a physical reaction. We begin breathing harder. Blood pressure rises. We're primed for action. Again, think of that saber-toothed tiger all of a sudden coming out of a bush a short distance from you. What is going to be your reaction? And so there's actually a physical response to the threat. And again, that was critical for our survival. And this whole thing is fast and automatic. On the other hand, the pleasure side, so that's the threat side we just discussed. The pleasure side it involves all brain areas, and it is very slow in involving. So when we have a pleasurable experience, it takes a while for us to respond. It's slow and complex. And so between the threat response and the pleasure response in our brain is the basis of loss aversion, which we hear a lot. In other words, we feel stronger about losses than we feel good about equivalent gains. Kahneman came up with two different ways we think about things. First is our fast decision, system one, which makes the vast majority of 1,000 decisions that we make during the day. It's automatic, it's easy, it's emotional. Again, those what are called heuristics or mental shortcuts to save energy by the brain is a pretty common way for this particular system to be working. So unless we turn that system off and turn on system two, this is the system that makes our decisions all the time. And one of the steps, again, to becoming better investor, emotional intelligence, improve that, is to be able to turn that system off and turn on system two, which is conscious effort, logical, and analytic methods. So it's a very, again, energy-intensive process. And again, you can understand why the brain doesn't like to turn that on very often. As Kahneman said, our brains are very lazy. We don't like to turn that on very often because it is, again, it's an energy hog. But it's that system two, which is the source of improved investor emotional intelligence. So what are some of these cognitive errors that we talk about, these emotional mistakes that we make? One of them, and this is incredibly important, is myopic loss aversion. Loss aversion is the idea that we react more strongly to losses than we feel good about gains. Sometimes people think it's maybe 2 to 1. Myopic, as we said, the brain is impatient. So we want to make a decision right away, even though maybe I'm managing my long-term portfolio. I want to make, when something happens, a drop in the market or drop in my portfolio, then I have this urge to make a decision right away. So we have the myopic loss aversion. This can be very costly. We see this all the time with investors that we work with. We just had an example of one that bought our portfolio right at the very peak last month and then sold it about a week and a half later. So that means he locked in the loss and missed the gain, which happened right away afterwards. And that's one of the problems with the markets. You tend to have big reversions, big up movements in the market after big losses. And so the myopic loss aversion can be very costly for your portfolio. Social validation. We like to do the same things everybody else. Again, this is hardwired. We used to live in small family groups 150,000 years ago. And when one member of the group took off, you didn't sit there and think, well, why do you suppose that person is running? And what you learn very quickly is that more than likely he saw or she saw something that you didn't, and you better respond, or otherwise that whatever that threat is you're going to be the victim. And so we have this that immediate response when we see that. So social validation is very powerful. It's hardwired in our 150,000-year-old brain. And in today's world with social media, it's even stronger. We see the action of crowds moving and making decisions in a wide variety of situations these days. So those two are really important. And again, to improve your investor emotional intelligence, to work on and try to improve in these two areas is really important. Then there's a number of others we are aware of. In fact, there's some people think there's a couple hundred of these that have been uncovered in research over the last 50 years. If you want to learn more about this, a very interesting book is The Undoing Project by Michael Lewis. He does a great job of writing in this area. And as a side story, he talks about the relationship between Kahneman and Tversky, those pioneers in behavioral economics. Does a very good job, like he does with each of his books. So let's take a look at the impact of making emotional cognitive errors on decisions. In particular, Kahneman and Tversky, one of the first things they started about in the 1970s, how do people estimate the probability of different events? If you don't have good probabilities, you have a very difficult time making good decisions. This particular chart here shows the S&P 500 for basically 90 years. The annual returns and how they are distributed. And for example, you can go down to minus 40 to minus 50, and that blue is the actual probability. Happens about 1% of the years. Those 90 years, about 1%. And then you go all the way over to the right, and then from 50 to 60%, it's about 2 to 3%, which we actually saw over this period of time. So Kahneman and Tversky asked, so how do you, as an individual, estimate these probabilities? Well, one way, obvious, is to look at the blue lines and say, okay, that's the probability of each of those particular returns. Well, they started studying this and found out that individuals have what is called a perceived probability. That in many cases is quite different than the actual probability. So for example, down in that minus 40 to minus 50, actual is 1%, but the perceived probability is 5%. In other words, the actual probability is 1 out of 100, and you perceive it as a typical investor as 5 out of 100. So 5 times more likely, that orange line. And as you move to the right and compare the orange line to the blue line, you see that individuals, and the average individual, overestimates the probability of negative events all the way up to the minus 0 to 10, minus 10 category. Then when we switch over to positive returns, it goes just exactly the opposite. Now from 0 to 10, we estimate that probability to be less than actual. And so if we go to the 10 to 20, which in actual is the most likely, is over 20%. Yeah, your perceived probability is somewhere more like 17% or 18%. And then if you go down to all the other positive, we see that the estimated probabilities, the perceived probabilities are all less than the actual probabilities. And so we have built into us a probability generating function that overestimates the likelihood of negative events like negative returns in the stock market and underestimates positive events. Obviously, if you can't come up with good probabilities in making decisions, then you're going to have a tough time making a good decision as a result of that. So again, one a really important step in investor emotional intelligence and improving that is to make sure you have good probabilities. And as Kahneman said, and others have said, keep your hands firmly on the data. In this case, the blue lines in this particular chart. So what does this actually mean? So the average annual return over this period of time was 11.6%. The perceived annual return based on the perceived probabilities is 5.4%. In other words, the actual return, 11.6%, but the perceived return is 5.4%. And so if what you're thinking is 5.4% and the actual return is 11.4%, pretty good chance you're not going to make a very good decision based on that particular probability. Now, it actually gets a little bit worse than that because you include loss aversion. In other words, not only figured out the probability of each of those returns, but once you get it, how do you value that particular return? And we know that we feel worse about losses than we feel good about gains. Kahneman, Tversky, and a number of others have gone through and estimated this. It turns out the perceived value return is a negative 2.7% for the typical individual. So the typical individual goes from looking at an actual return of 11.6% to a perceived return of negative 2.7%. Maybe this explains why so many people building long-term wealth insist on putting their money in money market securities, because if they perceive return as a negative 2.7%, then money markets are better in that regard. So perceived probabilities along with loss aversion leads to a double discounted perceived return. So how do you become a better investor, improve your investor emotional intelligence? Investors make consistent and predictable mistakes. They overreact to uncertainty and potential loss. They overvalue certain and readily available information. They're poor at estimating the probability, which we just went through, and they are subject to social validation, which we've talked about. The bedrock idea is planning based on needs rather than on fear. And the idea is you separate your needs and then build a portfolio appropriate for that particular need. Catastrophic loss typically would be insurance products. Known liquidity, you're typically looking at investing in putting money in bank accounts or money market funds or treasury securities. Regular income, we think dividend paying stocks is a great way to do that. And then long-term growth. Here, what we want to do is grow as much as we can and invest in the highest possible return. This allows you, again, to separate, in particular, to view short-term volatility and drawdown in an unemotional way and make better decisions as a result. So once we get out to long-term growth, then that short-term volatility and drawdown is not nearly as important in building portfolios. Again, it's expected returns. Another one is the long-term is longer than you think. I used to go into my classes, undergraduate, and teach investments, and I'd go up to the front row and I'd say, how long is your investment horizon? And I would say 50, 60 years, and they'd just look horrified when I would say that, because they could hardly imagine they were 20-year-old undergraduates, could hardly imagine being 25, let alone 65 or 70. But we really all have a long-term investment horizon, particularly building that long-term wealth growth portfolio. And so even somebody like myself who is in the 70s, I still have a very long investment horizon. And so that's, again, another very important step for that investor emotional intelligence, to realize that there is a long investment horizon that you're facing. The power of compound returns. Again, short-term compounding doesn't make much difference, but over the long run, it makes a huge difference, as we show here. So a 6% return versus a 10% return versus a 14% return. Over something like 30 years is shown here. It just makes a huge difference. And so that means kind of staying with your investments. Keep your money invested in that high return portfolio, and that builds wealth over the long run. It's kind of the magic of compounding. This is really the true risk with building long horizon portfolios, that you choose a lower volatility, lower drawdown portfolio, which you feel, less emotion over time, but you end up with dramatically less wealth as a result. Stocks really aren't risky. That seems strange, doesn't it? As we've tried to say, stocks are very emotional. They have a lot of volatility and drawdown. But once we consider a longer-term investment horizon, that pretty much disappears. So looking at 1 month returns, particularly 1 year returns, look at the dramatic 158% to minus 66% over this particular period, 1926 through 2017. But as we get longer and longer in investment horizons, that basically disappears. And by the time we get out to 20 years, now I've got a range of 2% positive to 18% positive. Very attractive. In other words, the minimum you'd earn, is showing in this particular case, is about the treasury bill rate, but you could earn as much as 18%, the average being 10 to 11%, somewhere in that range. So it's not risk. Again, volatility is not risk. Volatility is emotion. So let's try to, again, improve our investor emotional intelligence and separate volatility from risk. Another highly emotional part is market declines. Every year there are market declines in the stock market. And of course, 2020 was our most recent and one of the most dramatic. Between February and March of last year, stock market dropped 34%. And in fact, if you go back through time, this goes back to 1980, the average drawdown is 14%. Ooh, that's big. And that generates lots of emotions. But it turns out that over the same period of time, you ended up with a returns, 32 out of the 41 years were positive. An average 12.3% return, even though the average drawdown was 14%. So in other words, what goes down must go up in this situation. And you end up with a 12% return, even though you had a drawdown at some point during the year of 14%. And of course, 2020 was one of the more dramatic. We had a drawdown of 34%, but ended up 18% up for the year. Unbelievable. Who would ever think that would happen? We often get asked, when people are making investment decisions, is this the right time to invest? This is an example of a period, if you had invested in the stock market from 1990 through 2019, and you put in $10,000 a year, you would have total contributions of $300,000. If what you did is just automatically the first day of the year put money in, you'd end up with $1.7 million. If you invested in the worst day, you end up with $1.4 million. And if you ended up with the best, $1.8 million. So basically, the timing issue is not particularly important. In fact, it's better just to be, again, the advantage of investing is regular contribution. Just make the contribution, put it in the market, and then benefit from that compounding over time, which is shown here in this particular chart. Building a diversified strategy portfolio is a way to stay invested because strategies perform differently. These are the 10 strategies that we've identified. Future growth, competitive position, valuation, and so forth. And what this graph shows you over this 20-year period, that different strategies perform differently in each year. So rather than investing completely in one kind of strategy, diversify across strategies when you're building an active equity portfolio. Now, investing through the headlines, and that's one of the things that Carl brought up as a topic for this particular webinar. How important are current headlines for market returns? And it turns out, These are specific headlines in each one of these years. And we don't find very much relationship between the headlines and what happens in the stock market over time. And so in this case, we had the downgrade of the U.S. debt. We had, Paris massacre. We had Britain leaves the EU and so forth and so on. And people have actually studied this fairly carefully and have found very little relationship between these events, these news events, which dominate. I mean, I pay attention to the news. I'm sure you all pay attention to the news. And I find it really interesting to read about these stories and think about them. But I separate that from my investment decision because, again, I haven't found much relationship, nor has anybody else found a relationship between these news events and what happens in the market. We tend to look at markets and the economy in a consistent view. This is up on our website all the time, and we look at four basic categories. One is our behavioral measures. We have a large cap, a small cap, and a U.S. international developed, an international developed market barometer. And we look at those three measures and find out what the deep behavioral currents are driving the markets. As I said, emotional crowds drive the market, and we try to tap into the deep behavioral currents driving markets. Economic, we look at ISM, Institute of Supply Management, manufacturing and service, and those are now incredibly strong. In fact, this last month, they both hit record highs. So that's a very good foundation for the economy and also the market going forward. Valuation, we look at the forward PE. In this particular indicator, it's a little bit on the caution side. And then technical indicators. So these four, and looking across, so they're always mixed. Some are green, some are red, as normal. Every once in a while, all of them will be red, but that's pretty rare. Sometimes they're all excellent. That's pretty rare. So we look at this particular indication and say, well, behavioral is normal, economic is excellent, valuation of caution, technical is excellent. We think this is a positive indication for the stock market moving forward. So what about today's headlines? We've talked a bit about this. How about COVID, geopolitics, interest rates, inflation, and so forth? If we went back a year ago and somebody said stock market is going to be up 18% by the end of the year and the economy is going to be bouncing back, we'd have said, you're crazy. I mean, COVID had really disrupted everything around the world. But it turned out that things are bouncing back. COVID, of course, is a serious issue, one we have to deal with. But in terms of investing, it really is. I even found last year surprising in that regard because just how quickly it recovered. Geopolitics, we always got something going on. When I started back, I was in college in the 60s, and at that point, we had the 1967 war, and from that point on, there was always a crisis in the Middle East. You could always count on that, and that's less the case now, still an issue, but now we have China and Russia and various others. Again, very interesting conversations. I like to keep track of that. Does it help you make decisions investing? It's not so clear. Interest rates, studied that pretty carefully. A lot of people have. And what we found is that interest rates have very little impact on the stock market, which is really quite surprising because everybody talks about it all the time. But we've not found many consistent relationships there. Inflation, there's a lot of concern about that these days. I happen to keep track of money supply measures. The ones I keep track of that have historically been predictive of inflation are not signaling inflation at this point. But a lot of the people have different opinion about that. But the ones I keep track of indicate that inflation will not be a problem in the near term. So anyway, the headlines, what about that? And again, the way I like to look at it is I'm very interested in that. I follow the headlines. My background is economics. I love reading about that and thinking about that, but I've separated that from my investing decisions. because again, I'm always interested. I'm an empiricist. I want to find out, is there a relationship we can use here to make good investment decisions? And I've just not found those kind of relationships. If I found them, I'd use them, but I haven't found them. And so I try to separate those two worlds when I'm making my decisions. So up your investor emotional intelligence. Don't overreact to uncertainty and potential loss. Don't overvalue recent and readily available information. Better estimate the probability of events. In other words, keep your hands firmly on the data. Don't be a victim of social validation. Boy, that's a challenge in today's world, but it's even more important today. Avoiding these cognitive errors will increase your investor emotional intelligence. Okay? That opens us up for questions, I guess. Is that right, Brad?